Hello traders, it's ETM Effects, and in this lesson we're going to cover the silver bullet strategy, originated by Michael Huddlesfield. So I'm not going to waste a lot of time explaining the original strategy. We're going to go over it real quick, just because I want to get to my implementation of the strategy. Why? Because I've been trading for a few years now, the 9:30 stock exchange open. So I usually look for that opening drive of the market open as far as the volatility comes in. So I'm very familiar to the 10 a.m. to 11 a.m. range because it's really close to the time I trade, which is around 9:30 to 9:35. That and I've externally recorded my results, which is my 2 year results trading around that time frame. And I externally recorded just for the simple fact to avoid any confusion of Photoshop or I don't know all kinds of editing and stuff like that. So let's speed through the original strategy. So what you're looking for is your trading window is 10 a.m. to 11 a.m., right? So it's 30 minutes post the New York Stock Exchange open, post volatility, right? And the time frame you're trading on is the 1 minute. And what are you waiting for? What you're waiting for is price to take out a significant swing. So what is a significant swing? Any swing that was uh, previously made a reversal, right? So it's not these micro swings that are like this, right? Leading up to your main reversal, you're looking at significant swings. So you're looking for a run on liquidity for then the price to come back and then the comeback stop hunt that swing and then come back to a RTO or a fair value gap and then continue lower. That's what you're using as your entry. So the liquidity will be taken right here. This will be your significant swing. The liquidity got taken and your entry was somewhere here at your return to origin, or it could be lower, it could be your fair value gap. That's the basis of this strategy. So let's go into my implementation of the silver bullet. So first thing you want to do is ask the why. And before you implement the strategy, that's the first thing you must do. You must understand the why. And in the silver bullet strategy, you're asked to trade from 10 a.m. to 11 a.m. So here I have these boxes marked, and this is from 7 a.m. all the way to what? 10 a.m. And let's see what happens within this time frame. A lot of times at the end of this time frame, so from 7 to 10, a lot of times by the time it gets to 10, what happens? A lot of time the low of the day or the high of the day. Here within this box, so 7 a.m., you had the high of the day. Here you have the high of the day later on, so around 9:30, 9 o'clock to 9:30. So let's keep going. What occurs in this time frame? A lot of times, not every time, because nothing in this market is that frequent. Then it'll be extremely easy to get rich, right? So here you had the low of the day. Here you had the high of the day. Here you had the low of the day. Here you had the high of the day, and so on, so on. So now that you know around this specific time frames, this is when the high and the low of the day is formed. So if you know that the high or the low of the day is more than likely to be formed from 7 a.m. to 10 a.m., how can you implement this and into your silver bullet strategy, which is trading the post 10? So to trade the platinum bullet, you need to understand the 1 hour time frame. And again, I know you guys want to enter on the 1 minute, and we will do that. So don't be scared. Don't get nervous. We just need to understand the 1 hour time frame, and it would all make sense. But just to keep it simple, let's say this is our 7 a.m., 8 a.m., 9 a.m., 10 a.m. These are our times, right? And each candle is 1 hour, obviously. And this is our box that we previously had, which is from 7 a.m. to 10 a.m. And what we'll be looking at is to take a trade right here at this wick. Why would we try and take a trade at this wick? Because that's where the reversal would occur. This is where the high of the day in this instant will occur. And why is it in our benefit? Because just for the simple fact the risk to reward, right? So you can have a small risk right here and you can have a huge reward. It could even drop lower. Why? Because this is the day's extreme. So let's get into it. So here, let's draw our 9 a.m. candle. So this would be our 9 a.m. candle on the 1 minute time frame, right? It'd be multiple sequences of higher highs, right? A little bit higher lows, obviously for confusion purposes and hunts, but this would be our 9 a.m. candle. So now that we know this is our 9 a.m. candle, what do we have? We have our high right here. Let's make it red and let's add some thickness. Pause. So here is our high and here is our low, right? But we're mostly focusing on the high. And we'll get to why when we will know if it's a high of the day or low of the day reversal. Trust me, we can build a bulletproof evidence slash clues to indicate if this is going to be a high or a low of the day reversal. That is pretty simple. We'll get to it. Just have patience. But the basis of this strategy, so here you have your 1 hour candle, and what you're waiting for is for your 10 a.m. candle. Stay focused now. For your 10 a.m., once 10 a.m. comes in, you would want price to do what? Take out that high. What happens when it takes out that high? It forms this wick, right? So, and it comes back into the range, but and it starts heading down. But what happens when it starts heading down? So what you do is you look at your base. What is a base? It's the consolidation. What happens in these consolidations? Orders get injected, right? So you would put your fib, which is your quarters. Here, if you know anything about my videos, we really focus on quarters because when you really understand how price moves, it all makes sense. And all my previous viewers know what I'm talking about, right? So as the stop hunt occurs, when price comes back into the range, right, and it crosses the 50%, the fair price, because obviously you have your P right here and you have your D right here, this would be your F. This would be your fair price. So once price touches your fair price, you can get into a sell and have your stop loss right here, or you can have your stop loss at the extreme right. But your main thing is your base. So you would enter once you see the fair price right here. Once price touches the fair price, you would get in a sell using the momentum and you would ride it down. And this would be your wick on the 1 hour time frame. But on the 1 minute, this is what occurred. So let's get into in chart examples. So how do you know if it's going to be a high or a low of the day? All you need to do is see where the price is. So here we have our 9 a.m. candle and it just closed. So the next candle is our 10 a.m. candle, which would be our platinum bullet strategy entry. All you need to do is look to the left. Is price right now at its high of the day or low of the day? Price right now is at its high of the day. Why? Because this was the previous high. This candle right here broke the previous high. So right now, if this is a daily candle, think of it as right now we are at its peak. We are at the peak of the daily candle. So what are we waiting for? We're waiting for our wick. So what you look for now is your stop hunt. You would wait for price to make a run on liquidity and reverse and come back into a base, and you would trade the 50% of the base. And always look for a 1-to-1 minimum. So we're waiting for a run on liquidity to form the wick. Okay, now the wick is formed and price looks like it wants to come back. So what is the base right now? The base is this high, this low, and price consolidating in between. Again, high, low, price consolidated within here. And why are bases important? I explained this 1,000,005 times, but bases is where institutions inject liquidity. They can't just, let's say they're entering sell orders right here. Price would just dump. And if that happens on a frequent basis, everybody can make money because once you predict the once you predict the trend, you can just ride the wave. But there's a reason why price consolidates, drops, consolidate, drops. It's not just to make it harder for the trader. It's for the institutions to move large amount of funds. So the counterpart sells with buys, but the sells are much greater than buys, and they wait for a run on liquidity to fully push price down. And where would your entry be? Your entry would be once price touches the fair price, which is the median of the base. Okay, so right here, Again, you always look for a minimum 1 to 1. And once it hits your 1 to 1 target, you could always take out partials and leave a running position till later on. Let's say it's a quarter of your position, and if the trade runs 4R, then you can get an extra, or you can have your stop loss right here at the extreme of the range. But my suggestion is always have it at the peak. Better safe than sorry, right? Let's take it one step further. So, what would you do in this scenario, right? Price is bullish at the 9 a.m. The 9 a.m. candle close, which is the next candle is 10 a.m. It's bullish, but it's not at the high of the day. Why is it not at the high of the day? Because this is the high of the day. This would be your extreme. This would be your high of the day. Where's your low of the day? Your low of the day is right here. So what would you do here? First thing you want to look at is where was the extreme made? So the extreme was the low of the day, which is right here, and it was made in our box. What is our box? Our box is the New York peak, so it's 7 a.m. to 10 a.m. The fact that the low's been made, we know price is more than likely to reach for the other level of extreme. So price will be bullish. Why? Because the low of the day has been made. It's less likely to come back here and take it out again. Why? Because the low has been made already. So work with the clues that you already have. So when the low of the day has been already made within your significant time frame, which is that 7 a.m. to 10 a.m., you're looking for a continuation to take price higher. So what do you do next? You wait for a liquidity run. You would wait for a liquidity run and then for price to find a base and run through it. So basically, you trade through the base. Where are our significant swings? We have a significant swing right here. We have a significant swing right here. Why are we not using this swing? Because we are going bullish. Why are we going bullish? Because the low of the day has already been made. And we're using the momentum. So I know that might be confusing, but think of it like this. This is the low of the day as a 1 hour candle, right? It's already been made and price is already right here. You have a better chance trading away from the low of the day than back towards it. It's a game of probabilities. So what would you do? You would wait for a hunt. You have a swing right here. Okay. You have a swing right here. What are we waiting for? A liquidity run, then back into a base. What do we have? We have another swing right here. Okay. So price took the liquidity and came back inside of the range. So what would you do now? You would look at your base. Where is your base? Is your high, low, and price consolidated within this area. So what are you looking for? You're looking for a long once price hits fair price. And obviously you're looking for a 1 to 1, or your target could be the high of the day. So one more time for recap purposes before we move on. If the high and the low of the day has already been made within your New York session window, you're trading a continuation. If at 9 a.m. the 9 a.m. candle close is at its daily high or low, then you're trading a reversal. It's common sense. Okay, so here's our last example. What do we know now? How would you build context? This is the high and this is the low. When was the low formed? The low was formed in New York session in our box. So now the fact that we know the low of the day has been formed, you would be going bullish. Again, this strategy is not for guesswork. It's either you're in a reversal at the 9 a.m. candle close. Once the 9 a.m. candle closes, and if you're in a reversal, that's when you would look for your wick. But if the low of the day has already been set in your New York session, then you're trading against it. So right here, the low of the day has already been set. This is the low of the day. So what we'd be doing, we have a bullish bias because it wouldn't make sense to look for a short setup to trade back into our low of the day. So what would you do now? You would go on the 1 minute time frame and you would look for a run on liquidity. So here we have a micro swing right here. We have a micro swing right here. And we have a swing right here. Okay, so now we have another swing right here. Now we have another swing right here. Okay, price is coming back in the range. So what would you do next? You'll pull out your levels. You look at your base, which is the high and low. This would be your consolidation. It's basically your previous existing range, and you would take a buy when. Take a buy once price hits this level, and you're looking for your 1-to-1. All right, so this is the end for this lesson. Make sure you like, share, and subscribe, and let me know if you guys want more of the Platinum Bullet strategy. I'll make a few more videos if you guys want to, and make sure you comment which country are you watching from. This will help a lot. Later.